When do you actually become a Canadian tax resident? It's not when you hit your 183 days. It's not when you get your permanent residency, and it's not necessarily when you feel settled in Canada. Your tax residency in Canada is your starting point as it relates to your planning in Canada, so it's really important that you get this right. Hi, I'm Sonia. I'm a CPA licensed in both Canada and the US. I'm a cross-border tax consultant and co-author of my book, Your Move to Canada, all about navigating the financial, estate planning, and tax planning matters as it relates to moving from the US to Canada. So let's get started. Tax residency. First off, why does tax residency matter in Canada? Tax residency is the starting point because once you become a tax resident of Canada, you're subject to all of our Canadian tax rules. You're subject to tax on your worldwide income, you have a Canadian tax filing obligation, and you need to know the exact date you become a tax resident. And because this specific date is relevant for cost basis reporting purposes for a lot of matters, such as future capital gains, foreign asset reporting, and of course, just knowing that this date onwards, you need to report your worldwide income to Canada. But if you're not a Canadian tax resident, then Canada doesn't have the right to tax you on worldwide income. Instead, non-residents of Canada for tax purposes generally only have to pay Canadian taxes on Canadian sourced income, such as rental income from a Canadian property, capital gains from the sale of Canadian real estate, and Canadian pension income. The biggest misconception that I see is that people tie Canadian tax residency to permanent residency for immigration purposes. These two are entirely separate. Generally speaking, your immigration status does not have a bearing on your Canadian tax residency. If you come to Canada on a study permit, a work visa, or even a visitor permit for some situations, you could have established Canadian tax residency. For most people, making a one-way move to Canada where you have the intention to live here for the foreseeable future and you're going to have a home here that's available for your use, you generally will become a tax resident as of the day that you physically arrive here. So the Canada Revenue Agency, or the CRA, our tax authorities, looks at various factors to determine whether someone became a Canadian tax resident. And these are primary ties and secondary ties. Primary ties have more weight. These are things like a home that's available for your use in Canada. Do you have a spouse or common law partner in Canada? Do you have dependent children in Canada? And then secondary ties hold less weight, but they're still important. Other things that may tie you to Canada are things like your personal belongings, professional memberships, financial ties, economic ties, a job here in Canada, provincial healthcare coverage, a driver's license, and importantly, intention. Is your intention to live in Canada? So overall, you don't need to hit every single one of these ties, but it's a holistic view. We look at when you came to Canada, did you have the intention to move here? Did you establish residential ties? Are your ties here stronger than they are to your other country? If so, generally you'll become a tax resident on the day that you arrive here. But sometimes it's not really that clear and straightforward. There are situations where you'll come to Canada and you won't establish Canadian tax residency right away. And these are always situations where you have to get professional guidance from a qualified cross-border tax accountant or a tax lawyer. Common situations are coming to Canada but still having a home back in your original country, such as the US, and frequently traveling back and forth between both countries and not really fully establishing all your ties here. If you're coming from the US and you meet tax residency under both Canadian domestic rules and under US rules, then generally the next step is to look at the tax treaty. There are a number of treaty tiebreaker tests which look at which country ultimately has residency rights over you. They look at where you have a permanent home. If you have a permanent home in both countries, then the next test is center of vital interests. And if your center of vital interest is equal between both countries, they look at where is your habitual abode? Where do you generally go to sleep at night? Where is your regular home? And if that's inconclusive, then generally the last test is where are you a citizen of? But for the most part, if you're making a one-way move to Canada and you kind of severed most of your ties in your other countries, such as the US, generally you'll be a resident when you arrive here. Let me clear up one of the biggest myths that I see, and that is the 183-day test. A lot of people think, I was in Canada for less than 183 days in the year, so I'm not a resident, right? Well, generally speaking, if you made a one-way move to Canada and you severed your ties to your other country, the 183-day rule doesn't really come into play. Where the 183-day rule generally applies in Canadian residency tax rules is when someone comes to Canada, doesn't establish residential ties here, say they're staying with family members or at a hotel, and they also don't have a residency in another country that Canada has a tax treaty with. For that case, if they exceed 183 days in Canada, then they'll be considered a deemed resident for the entire calendar year. But for the most part, if you have someone who's just moving from the US, made a one-way move, even if they say moved on December 30th of a given year, they may have established residency on December 30th and become a tax resident on that day forward. We have part-year residents, and you could definitely become a part-year resident even if it's in the latter half of a given calendar year. Now at this point, you may wonder, who decides my tax residency and how do I declare it? So Canada, similar to the US, has a self-reporting tax system. This means that you have to report the date that you become a resident, and you are responsible for defending this should the CRA come back and later question you on it. But that doesn't mean you have to do this alone. I always recommend that people get professional cross-border tax advice specifically for the year that they are going to move, ideally well ahead of the move as well. There are lots of planning opportunities that are available only before you actually become a Canadian tax resident. And the way you actually tell the Canadian tax authorities that you became a tax resident is through reporting that date on your first Canadian tax return. So on your tax return for the year you become a resident, there's a section on the first page. All you have to do is indicate that date. And then when you file your tax return, that is how the tax authorities know you became a tax resident. There's no declaration that you have to make to the Canadian tax authorities when you cross the border. And again, a cross-border tax advisor will be able to help make sure that you can determine what this date is and that it's well supported. So as I previously indicated, when you become a Canadian tax resident, you're subject to tax on worldwide income. So residency timing can make a huge difference. For example, let's say that you're working at an employer and you're expecting a big bonus. Let's say that this bonus is set to be paid February 1st, 2026, and you're anticipating to move to Canada sometime in the first quarter of 2026. If that bonus relates to work that was fully done in another country, such as the US, and it's paid from the US employer, then if you establish Canadian tax residency before that bonus is paid, then that bonus is fully reportable on your Canadian tax return and subject to tax at Canadian marginal rates. Now, of course, you can get a foreign tax credit for the foreign taxes that you paid on that bonus, but if the Canadian tax rates are higher, which they often are, you may be out of pocket onto some taxes to the Canadian tax authorities. Alternatively, if you plan around moving and establishing residency until after certain taxable events, such as getting this big bonus, you could have potentially saved a lot in taxes. So that's why timing residency matters. Making sure you're getting this date correct matters. So that's why me and my co-author wrote this book, Your Move to Canada. There are so many intricacies involved in a move from the US to Canada, and we wanted to make sure that we put all of our experience and professional expertise working with hundreds of families over the years, guiding them through this move into one comprehensive guide. So make sure you check out the link in my bio to check out Your Move to Canada. And make sure you leave a comment. Is there anything that surprised you about tax residency in Canada? What other kind of cross-border tax videos do you want to see? Have a good day. Bye.